We will walk through the main types of legal entities in Denmark and how to think about them when planning a new business or restructuring an existing one. Our objective is to give you a clear, practical overview so you can engage more effectively with your legal, tax, and advisory partners and make decisions that fit your strategic, operational, and risk profile. While the Danish legal landscape is relatively straightforward by international standards, there are important nuances that can have a significant impact on governance, liability, taxation, and investor expectations. We will focus on the entities most relevant for commercial activity: the sole proprietorship, the general partnership, the private limited company or APS, the public limited company or AS, and a few additional structures that are particularly relevant for foreign investors and holding setups. We will not provide legal or tax advice here. Instead, we will equip you with the decision-oriented framework to discuss options with your advisors in Denmark. Let us begin with the simplest form, the sole proprietorship, known in Danish as an enkeltmandsvirksomhed. This is not a separate legal person, or rather it is an extension of the individual. It is quick and inexpensive to set up, has minimal administrative burdens, and is often a starting point for freelancers, consultants, and very small businesses. Income is taxed as personal income, and the owner has unlimited personal liability for the business's obligations. This unlimited liability can be a critical consideration when the business involves material contractual obligations, employees, or external financing. In many cases, a sole proprietorship is suitable for a low-risk, service-based activity. But as the business grows or introduces higher risk, it is common to transition into a limited liability structure. Moving one step up in complexity, Denmark also offers partnership structures, the most common being the general partnership, or intraselskab, abbreviated IS. In an IS, two or more partners operate a business together. Again, the partnership itself is not a fully separate liability shield in the way a corporation is. The partners are typically jointly and severally liable for the debts and obligations of the business. From a tax perspective, the partnership is often treated as transparent, meaning profits are allocated to the partners and taxed at their level. The IS can be attractive for professional services, joint ventures, and family businesses, where partners want flexibility and are comfortable with shared risk. However, the absence of limited liability usually prompts more mature or externally financed ventures to consider corporate forms instead. For most domestic and international investors, the central entities in Denmark are the private limited company, anpartsselskab or APS, and the public limited company, aktieselskab or AS. Both are separate legal persons. Both offer limited liability to shareholders, and both are governed by the Danish Companies Act, which is generally seen as transparent, investor-friendly, and aligned with broader EU standards. An APS is often the default choice for small and medium-sized enterprises, subsidiaries, and holding companies. It has a relatively modest minimum share capital requirement, which at the time of recording is in line with a low-barrier, SME-friendly regime. Capital can typically be paid in cash, and in some cases, contributions in kind are also possible under defined conditions. Governance is flexible. An APS must have a management body, but the board structure can be simpler than that of an AS. And the formalities around general meetings, reporting, and decision-making are generally lighter. For foreign investors entering Denmark, establishing a Danish APS as a wholly owned subsidiary is a common route, as it facilitates local contracts, hiring, and banking while ring-fencing liability. In contrast, the AS is designed with larger, often more complex enterprises in mind, particularly those with broader shareholder bases, capital markets ambitions, or regulated activities. The minimum share capital requirement is higher than for an APS, and governance obligations are correspondingly more robust. An AS must have a more formalised board structure, often with both a board of directors and an executive management, and in some cases employee representation on the board is required once the company reaches certain thresholds. The AS form is typically chosen by companies planning to raise significant equity, attract institutional investors, or list their shares on a regulated market, even if the initial operations are not large. For both APS and AS, the benefits include limited liability, clearer separation between ownership and management, and a corporate framework that is internationally recognised and relatively easy for investors and banks to understand. Danish law also allows for various specialised and hybrid structures. One example is the limited partnership, or kommanditselskab, abbreviated KS. In a KS, at least one partner has unlimited liability, while one or more limited partners have their liability capped at the amount of their investment. This structure is frequently used in real estate, private equity, and certain investment vehicles because it combines an element of liability protection for investors with partnership-style tax treatment. The KS can be efficient from a financing and risk allocation perspective, but it requires careful structuring and professional guidance to ensure it meets commercial, tax, and regulatory requirements in Denmark and in investors' home jurisdictions. For international groups, another important consideration is whether to operate in Denmark through a branch or through a subsidiary. A branch or filial is not a separate legal entity, but an extension of a foreign company registered to conduct business in Denmark. A branch can be attractive when a foreign parent wants a direct presence without creating a new Danish company, but it implies that the foreign parent ultimately bears liability and that the branch's activities are directly linked to the parent's financial statements. A subsidiary, typically an APS, creates a distinct legal person in Denmark, which can be advantageous for managing risk, accommodating local investors or key employees as shareholders, and aligning with local financing practices. The choice between branch and subsidiary is influenced by tax, regulatory, and operational considerations, and should be evaluated in the context of the group's broader European structure. Many corporate groups also use Danish holding companies to consolidate shareholdings, optimize dividend flow, and facilitate acquisitions or divestments. Denmark's participation exemption rules and extensive tax treaty network can be attractive in certain scenarios, but the effectiveness of a holding structure depends heavily on the specific countries involved and on evolving international tax standards. As such, while the APS or AS form is often used for holding purposes, the real value lies in careful planning around substance, governance, and alignment with the group's long-term strategy. Across all these entity types, there are cross-cutting themes you should keep in mind. Liability is a primary dimension. Moving from sole proprietorship and general partnerships to APS or AS typically reduces personal exposure and can enhance credibility with counterparties. Tax treatment is another key factor. Transparent entities like sole proprietorships and some partnerships push income directly to individuals, whereas corporate entities create a separate layer of taxation, sometimes with deferral opportunities or different treatment of retained earnings. Governance and compliance requirements increase as you move toward larger, more regulated forms, but so do the options for attracting capital, issuing shares, and professionalizing management. Finally, alignment with stakeholders matters. Investors, lenders, and strategic partners often have clear preferences around legal form, especially when making cross-border commitments. To move forward effectively, start by clarifying your strategic objectives, your risk tolerance, and your expected funding model over the next 3 to 5 years. Then discuss with Danish legal and tax advisors which entity type or combination of entity types best supports those objectives. In many cases, particularly for international groups, the optimal solution is not a single company, but a structure involving an operational entity, potentially one or more holding entities, and where relevant, partnerships or branches tailored to specific projects. Denmark offers a robust and predictable legal framework for all of these options. And with the right guidance, you can design an entity structure that supports both current operations and future growth.